Accrued revenues are revenues that are earned, but for which cash has not yet been received. So a lot of times we call this providing services on account or sales on account. Oftentimes, accrued revenues end up being recorded as accounts receivable. So that's helpful to remember. Accrued revenues are often accounts receivable. And almost all of the time, accrued revenues are recorded as a receivable of some sort. So accrued revenues are fees that are earned, sales that have occurred, but they haven't been recorded yet, and you haven't gotten cash for them yet. So different types of accrued revenues. Accrued service revenue would be recorded as accounts receivable, just like accrued sales revenue would also be recorded as accounts receivable. Any other type of accrued revenue, you would just look to see what type of revenue it is, and that will help you know what to call the account. So for instance, if it's accrued interest revenue, it would be interest receivable. But again, most accrued revenues will be receivables. Accrued revenues are assets. Think about accounts receivable. That's an asset because you will be receiving cash for it in the future. So an example would be a company sold a product in January but won't receive payment until February. So at the end of the month, at the end of January, when the company is determining that some revenue has been earned that hasn't been recorded yet, they would need to make this adjusting journal entry. They would know that revenue has been earned, and so it should be recorded. Of course, when you earn revenue, you credit the revenue account. But instead of debiting cash, because cash has not yet been received, the company debits accounts receivable, meaning that the cash will be received in the future. So we'll say that that sale was for $500. Well, in February, when the company receives the cash, they'll then debit cash to show the cash received and credit accounts receivable because that reduces the amount in the accounts receivable account. So a journal entry that we can do. In the second week of December, Fast Forward agreed to provide 30 days of consulting services to a fitness club for $90 a day. At December 31st, 20 days of service have already been provided, so we need to prepare the adjusting entry. So the adjusting entry will take place on December 31st. The agreement was for $90 a day, and 20 days of consulting have been provided. So 20 days at $90 per day is $1,800. So they've earned $1,800 but haven't received it in cash yet. So since they haven't received it in cash, but they need to record the revenue, they debit accounts receivable because they will be receiving the cash in the future, and credit consulting revenue because the revenue has been earned, so it can be recorded as revenue at this time, and the amount is $1,800.